This week, the global economy didn't move as one. Instead, we saw a clear divergence, country by country, as the US-Israel-Iran conflict reshaped inflation, growth, and policy across the world. Let's break it down, one economy at a time. Starting with the United States, the economy continues to send mixed but critical signals. On the positive side, job growth rebounded in March and unemployment fell to 4.3%. Retail sales also surprised to the upside, and manufacturing activity expanded at its fastest pace since 2022. But the cracks are fusing visible in global companies delaying IPOs and slash dividends as Middle East conflict rattles markets. Services activity shrank in March for the first time in 3 years, as a gauge of new business slumped in the wake of the Iran war. At the same time, gasoline prices have surged above $4 per gallon, and input costs are rising sharply due to the war. Officials at the Federal Reserve are now warning that inflation could remain stuck around 3%. The U.S. trade deficit widened in February by 4.9% from the prior month to $57.3 billion, which was less than forecast as both imports and exports increased. To manage this downside risks, investors are piling into cash, with money market fund assets hitting record highs. Private markets continue to show stress. Blue Owl has already limited withdrawals after heavy redemption requests. And on the policy front, trade and geopolitics are intensifying. The U.S. is maintaining aggressive tariffs, while also doubling reinsurance support to $40 billion to keep oil flowing through the Strait of Hormuz. The U.S. Customs Agency said it was making progress in setting up a streamlined process for refunding some $166 billion in tariff collections deemed illegal by the Supreme Court, but that its new system could take up to 45 days. A resilient economy, facing rising stagflation risks and tightening financial conditions. Now, China. In a world of energy shocks, China stands out as one of the most resilient economies. China has spent years preparing for exactly this kind of disruption. It has large oil and gas stockpiles, diversified energy imports, and an electricity grid largely insulated by domestic coal and renewables. Its electric vehicle fleet is now roughly the size of the rest of the world combined, significantly reducing oil dependency. And it's not just resilient, it's opportunistic. Chinese firms are reselling LNG at record volumes, capitalizing on global shortages. Markets have responded, with Chinese assets outperforming and attracting global capital. But there are still challenges. The People's Bank of China is signaling weak demand and external risks, maintaining liquidity support while holding back on aggressive rate cuts. At the same time, trade tensions with the U.S. are rising again, and Chinese exporters are cutting prices to find alternative markets. Still, relative to the rest of the world, China looks insulated, and in some cases, advantaged. Next, the Eurozone. This is where the pressure is building the most. Inflation is rising again. March CPI saw its largest increase since 2022, and German inflation has hit a one-year high. At the same time, growth is deteriorating. Germany's GDP is now expected to grow just 0.6% this year, a sharp downgrade from earlier forecasts, and the currency is reflecting it. The euro is heading for its worst quarter since 2024, as energy dependency becomes a major vulnerability. Fuel shortages are already emerging in parts of Europe, with hundreds of French stations running dry. The European Central Bank now faces a difficult balancing act: tighten policy to control inflation or support a weakening economy. Even Christine Lagarde has pushed back on overly optimistic views about the war's economic impact, cited by Treasury Secretary Scott Bessent. The bottom line? Europe is entering a stagflationary environment with limited policy flexibility. Now, Canada. The economy started the year on stable footing, with modest GDP growth of 0.1% in January and 0.2% in February. But the energy shock is beginning to bite. Gasoline prices just recorded their largest monthly increase since 1950. That's a major hit to consumers. At the same time, policymakers are navigating a complex trade environment. Canada is considering measures to protect domestic industries from low-priced imports, while also dealing with U.S. tariffs and restrictions on Chinese electric vehicles. There are also structural shifts underway. Energy dynamics are changing, with refiners turning to domestic sources like Newfoundland as Middle Eastern supply is disrupted. And politically, tensions are rising, with Alberta independence efforts gaining traction, even if still a long shot. The key takeaway? Canada benefits from higher oil prices, but faces growing pressure on consumers and trade. In the United Kingdom, the picture is becoming increasingly challenging. Growth is already weak, with the economy barely expanding at the end of 2025. Now, the Iran conflict is adding a new layer of pressure. Manufacturing has contracted for the first time in 6 months, and businesses are planning to pass through higher energy costs to consumers. The Bank of England is also raising concerns about financial stability risks, particularly from the growing use of artificial intelligence in financial markets. And structurally, the UK may be among the hardest hit. The Organisation for Economic Cooperation and Development expects the UK to feel a stronger impact from the war than its Eurozone peers. The result? A fragile economy, facing rising inflation and limited policy room. Finally, Japan. Japan is also feeling the effects of rising energy prices, but the policy response is different. The Bank of Japan is maintaining a tightening bias, signaling that interest rates will continue to rise if forecasts hold. At the same time, policymakers are increasingly concerned about spillovers. That brings this week's edition to a wrap. If you enjoy this content, please remember to like, share, and subscribe.